Sometimes, a great company doesn't disappoint the market. The market simply changes the rules. That's exactly what may have happened to Apple. This wasn't a quarter defined by weak execution. It was a quarter that revealed something far more important. Wall Street is no longer evaluating Apple by the standards that made it one of the world's most valuable companies. For years, investors rewarded Apple for building an extraordinary ecosystem, generating exceptional cash flows, and delivering consistent earnings growth. Today, those strengths are no longer enough. The market is asking a different question. Not whether Apple can build great products. Not whether Apple can sell more iPhones. But whether Apple can create the next wave of growth in the age of artificial intelligence. And that single shift in expectations may explain why Apple did almost everything right, yet still lost the market's confidence. Let's examine why Wall Street quietly raised the bar. If Wall Street truly raised the bar for Apple, then we should expect to find major weaknesses in this earnings report. But that's exactly what makes this story so compelling. There were very few. Apple delivered another high-quality quarter. Revenue exceeded expectations. Earnings came in ahead of consensus. The iPhone remained resilient despite an increasingly competitive smartphone market, while the Mac business posted one of its strongest growth rates in recent years. Operationally, Apple continued to demonstrate the discipline that has defined the company for more than a decade. In fact, if you looked only at the financial results, this should have been the kind of quarter that reinforced investor confidence, not weakened it. Which leads us to a much more important conclusion. The numbers weren't the problem. The market saw the same results everyone else did. It simply reached a different conclusion. Because the question was no longer how well Apple performed this quarter. The real question had become whether this quarter changed Apple's long-term growth story. This is one of the most important principles in investing. Stocks don't move because of what happened yesterday. They move because investors constantly reassess what the future is worth. That's exactly what happened after Apple's earnings. The market wasn't questioning Apple's execution. It wasn't questioning the strength of the iPhone, or the company's ability to generate cash. Those have been Apple's strengths for years. Instead, Wall Street began asking a much bigger question. Has Apple's future become more valuable than the market already expected? That's a very different question. When a company trades at a premium valuation, investors aren't simply looking for another strong quarter. They're looking for a reason to raise their expectations even further. And this is where Apple's challenge begins. The earnings report confirmed that Apple remains an exceptional business. But it didn't convince investors that the company's long-term growth trajectory had fundamentally improved. That distinction explains why a great quarter wasn't enough to move the stock higher. If Apple's hardware business wasn't the problem, then where did Wall Street begin to lose confidence? The answer lies in services. Over the past decade, services has evolved into Apple's most important profit engine. Businesses like the App Store, iCloud, Apple Music, Apple Care, and subscriptions generate recurring revenue with significantly higher margins than hardware. More importantly, they have given investors confidence that Apple could continue growing, even as the global smartphone market matured. This quarter, however, services didn't tell a stronger growth story. The business is still healthy. It continues to generate substantial cash flow. But it wasn't strong enough to convince investors that Apple's long-term growth outlook had materially improved. And that's the key difference. Wall Street wasn't saying Apple's services business is weakening. It was saying the company's most valuable growth engine no longer provides enough evidence to justify even higher expectations. If services wasn't enough to change the narrative, Then what exactly was Wall Street looking for? The answer is surprisingly simple. Proof that artificial intelligence can become Apple's next engine of growth. Today, investors are no longer impressed by AI announcements alone. Every major technology company is investing billions of dollars into AI. What separates the winners from everyone else is the ability to convert those investments into faster revenue growth, expanding margins, and higher earnings. And that's where Apple faces a unique challenge. Unlike Microsoft, Nvidia, or even Meta, Apple isn't yet showing a clear financial impact from AI. The company has outlined an ambitious long-term vision, but investors are still waiting to see when that vision begins translating into measurable business results. In other words, Wall Street isn't questioning whether Apple has an AI strategy. It's questioning when that strategy will become a growth strategy. If Wall Street is questioning Apple's AI strategy, then one recent announcement deserves much closer attention. Just weeks before reporting earnings, Apple expanded its long-term partnership with Broadcom through 2031, committing more than $30 billion to advanced silicon and chip technologies manufactured in the United States. This wasn't just another supplier agreement. It was a strategic investment in the infrastructure that could power Apple's next generation of AI products and services. In other words, Apple isn't ignoring the AI race. It's building the foundation before trying to monetize it. But here's where the market remains unconvinced. Investing billions of dollars doesn't automatically create billions of dollars in new revenue. Wall Street wants evidence that these investments will eventually translate into stronger growth, higher earnings, and a larger addressable market. Until that connection becomes visible, investors may continue treating Apple's AI strategy as a promise rather than a proven growth engine. One of the biggest risks of becoming one of the world's most valuable companies is that success eventually becomes the baseline. Investors no longer expect Apple to deliver good results. They expect Apple to consistently exceed already ambitious expectations. That's the challenge of trading at a premium valuation. When expectations are this high, a strong quarter doesn't necessarily create upside. It simply confirms what investors already believed. To push the stock meaningfully higher, Apple needed to convince the market that its future earnings power had fundamentally increased. This quarter didn't do that. The earnings were strong. The business remains exceptional. The long-term strategy is intact. But none of those factors gave Wall Street a compelling reason to raise its long-term growth assumptions. And when expectations rise faster than the investment story, even excellent execution can lead to a disappointing market reaction. By now, the market's reaction starts to make more sense. Apple has already done many of the right things. It has invested heavily in artificial intelligence, expanded its long-term partnership with Broadcom, and continues to strengthen one of the world's most valuable ecosystems. From a strategic perspective, the direction is clear. But strategy alone doesn't drive valuation. Evidence does. Today's market is no longer rewarding companies simply because they have an AI roadmap. Investors want measurable proof that AI can accelerate revenue growth, expand margins, and ultimately increase long-term earnings power. And that's the missing piece in Apple's investment story today. The company has demonstrated its commitment to AI, but it has not yet demonstrated the financial impact of that commitment. That doesn't mean Apple is falling behind. It simply means Wall Street is waiting for evidence before assigning a higher valuation. Until that evidence becomes visible, Apple may continue to be judged not by the quality of its strategy, but by the pace at which that strategy turns into financial results. If there's one company that has consistently challenged Wall Street's short-term expectations, it's Apple. History shows that Apple rarely wins by being first. Instead, it wins by building products, technologies, and ecosystems that create lasting value over time. The iPhone wasn't the first smartphone. The Apple Watch wasn't the first smartwatch. Even Apple's custom silicon arrived long after many competitors had entered the market. Yet in each case, Apple focused on integration, user experience, and ecosystem strength rather than speed alone. Its AI strategy appears to follow the same philosophy. Rather than rushing to monetize artificial intelligence, Apple is investing in the underlying technologies, silicon, and ecosystem needed to support AI for years to come. That approach may not satisfy investors looking for immediate financial results. But if history is any guide, Apple has often created the greatest value by thinking beyond the next quarter, and focusing instead on the next decade. This brings us to the central dilemma facing investors today. Apple appears to be making decisions that maximize long-term value. Wall Street, however, is trying to determine how much of that value will become visible over the next few quarters. Those are two very different investment horizons. The market isn't questioning whether Apple can afford to invest in AI. It already knows Apple has the financial strength, engineering talent, and ecosystem to compete for years to come. The uncertainty lies elsewhere. How long will it take before those investments begin contributing meaningfully to revenue growth, earnings, and shareholder value? No one knows the exact answer. And when the timing is uncertain, markets often become more conservative in how they value future growth. That's why Apple's recent sell-off may say less about the quality of its business, and more about the market's willingness to wait. In investing, timing can influence valuation just as much as execution. At the beginning of this video, we asked a simple question. How could Apple do almost everything right, and still see its stock move lower? After looking beyond the headlines, the answer becomes much clearer. Apple's business didn't suddenly become weaker. Its competitive advantages didn't disappear overnight. The company continues to generate extraordinary cash flow, maintain one of the strongest ecosystems in the world, and invest aggressively in technologies that could shape its future. What changed wasn't Apple. What changed was the standard by which Wall Street evaluates Apple. In the AI era, investors are no longer satisfied with consistency alone. They want evidence that the next wave of innovation can create the next wave of earnings growth. Whether Apple can deliver that proof remains one of the most important questions for investors over the next several years. But one thing is already clear. Apple didn't do everything wrong. Wall Street simply raised the bar. And that may be the real story behind Apple's post-earnings sell-off. As always, this video is not financial advice. Please do your own research before making any investment decisions. Thank you for watching. If you found this analysis helpful, don't forget to like, subscribe, and I'll see you in the next equity research.